Okay, dear ladies and gentlemen, we welcome you in the name of SIA. We are absolutely pleased to have currently as much as 34 participants on the call, and people keep me busy by accepting additional people that are actually trying to dial in. We have a lot of this to discuss today. That's why I would like not to lose any time and will pass on immediately to Carlos.
Okay, well, thank you. Good morning. The first point we wanted to discuss is, as you can see in the slides coming up, is about the environment and how the virus. Yeah, you can go on. Just one more slide, Alex. Yeah. Okay. It is hard to believe, but it is less than a year and a half ago that all this COVID exercise started. At the time, it was scientific consensus that developing a vaccine for this kind of thing would take between 10 and 15 years, because this is what had taken in the past. The reality is that as of today, more than 1.7 billion doses of the vaccine have been administered, which is truly unprecedented, which in parentheses, again, underlines that mankind is fairly resourceful. I mean, sometimes things really go all right, but most times when people get to it, we can get things done. And the experience is that the vaccines work. I mean, it's very simple. We keep reading in the press every 2 weeks that there is a new variant, and this one is not going to. I mean, the vaccines won't be able to protect us against that one, but that is not the case. Every single variant, now the latest one is the Indian one, but you can be sure that in 2 weeks' time, we'll have another one, because that's the way viruses work, by the way. And the vaccines so far seem extremely competent. In fact, what we can see in the next slide is that we've been more or less following this, and although it is far from an established fact, when we see that the percentage of the population that has received at least one shot of the vaccine reaches 50%, the pandemic starts really disappearing very fast. It doesn't mean that it stops completely, because there is some momentum, obviously, but it starts going down in a way that seems pretty much permanent. We saw that, of course, first of all in Israel, because it was the first country that got to that point, but we have seen it in the UK. We have seen it now in the US. The US started from nothing 4 months ago. Now they've vaccinated more than 50% of the population, and the rates of infection, hospitalization, deaths, etc., have dropped dramatically. And then, I mean, we could put, obviously, all the charts are the same, but you look at Germany and France, where now they're reaching 35% of the population, so they're behind. But you can see how things start dropping, and they are not as low as in Germany. I mean, the number of infections, they're not as low as in the UK or the US. They are dropping very fast. Very important, these countries are vaccinating now, well, not the UK or even the US, because they're well advanced, but France, Germany, they're vaccinating now about 0.7% of the population per day. That's in 10 days, it's 7%. I mean, that is a lot. All this means that in about 1 month's time, the whole thing, it will not be over. It will probably never be over, like the flu is not over. And every year, many people, unfortunately, die of the flu, but it is not something that blocks our society and our lives. As you can see in the next slide, this has already had an impact, as you would expect, on economic activity. And again, there we could put lots of different statistics. I was reading today, gasoline consumption in the US, what they call implicit demand, it is now higher than before the pandemic, higher than in 2019. And that is a very good measure, because people drive to things. They don't drive just for driving. They drive because they're working or eating or doing something. So that tells you that the whole economic activity is rebounding very fast. Although there is still a gap, as you can see on the left, on the right-hand side chart, things have gone up enormously, but there's still a gap, which means that the economy is going to continue accelerating in the next few months. And the point is, if we go to the next slide, that it is not only that we're getting under this thing, but it is also that there is a change in economic thinking. We've discussed this in the past. I don't think I'm not going to say we're going to discuss it much in the future because it's not a good idea to bore the audience. But this is, if we're right, this is something that is going to stay with us for a very long time. We have had an economic consensus that has lasted, I don't know, 40, 50 years, that has directed more or less economic policy, that has led to many things that 50 years ago were unthinkable, like central banks should be independent from the government. Well, nobody did that, and nobody thought that would be a good idea. Now, 5 years ago, everybody thought that was the only way to do things. So things do change. We've had a very long period in which the key enemy was inflation. Obviously, that is a legacy from the very traumatic experience in the 70s. So that's 50 years ago. And that war has been won. I mean, there has been no inflation for a very long time, even if the monetary policies have been very different to what people thought. The truth is we have had no inflation. We have no inflation. But of course that, and we had very low interest rates, which is good and is bad. I mean, it's good for people who want to borrow money. It's very bad for investors because, you know, it means you are not getting rewarded for your capital. Obviously, this has led to ever increasing asset prices. Obviously, if an asset that used to yield something yields less, obviously the price goes up. We've seen that with stocks, we've seen that with houses. Any capital good has been increasing in price basically for the last 40 years, which is very good news in this case for people who own those assets, but very bad news for people who do not. We have seen inequality grow enormously. Obviously, there are many reasons why that could be the case, but that is a fact. And the fact is that for the lower part of, from an economic point of view, the lower part of the population has not seen its purchasing power increase in probably 40 years' time. Well, that has had a very bad effect on aggregate demand because it is the poorer people who spend more money as a percentage of their income. Actually, they spend all their money as a percentage of their income. So if those people do not get more income, there is no more spending. It's as simple as that. So we have seen governments increasing debt, not just right now because of the pandemic, etc., but over the last 40 years, because they have been trying to add demand to an economy that is not generating enough demand. And that's the situation we've had. Now, with the new consensus, a little bit is that, well, unemployment is more important than inflation. Inflation is not good. We should not have inflation. But if there is a little bit of it, well, so be it. Unemployment is more important. We have to rebuild infrastructure. As part of the consensus of low interest rates, low deficits, most industrial economies have not invested in infrastructure for a long time. You go to the richest countries in the world, like Germany, certainly the US, UK, Switzerland is better in that respect, and France somewhat. But and you see infrastructure crumbling. Roads, airports, bridges, everything. Now that also has an effect on growth. Infrastructure is needed for growth. So governments have decided to correct those things, and that has, if that happens, that's going to have many impacts. But for investors, what that means is basically higher taxes, somewhat higher interest rates, probably not much higher, but certainly higher. higher inflation, again, probably not very high, but certainly higher than the almost zero inflation we've had for a long time. Probably an increase in productivity. Companies do not invest in productivity enhancing things if they don't have to, obviously. Now, if there is unemployment, if salaries are low, it is cheaper just to hire more people to do the job than buying a machine. It is not a coincidence that the country with the highest salaries in the world, which is Switzerland, is probably the most productive country in the world. Yeah, you have to, otherwise you cannot have those salaries. It's very simple. So we should see higher productivity, faster economic growth, and for some people, higher profits. Obviously, bad news is higher taxes and higher interest rates. The good news is higher taxes on higher profits. So if we go to the next slide, if these things happen, well, what we will see is a change in the leadership in the markets. For the last 30 years, we've had leadership in things which were capital light, and certainly not addressed to the common man. I mean, big money has been made, certainly in financial services, in all kinds of things, in many things, technology, things which were well adapted to the environment. Right now, we should, if this change in economic leadership in demand happens, we should see much more emphasis on manufacturing, on things. I mean, put it in very simplistic terms, rich people are not going to buy more cars, no matter how much the economy grows, but poor people will, particularly in countries where they still do not have any car. So that has a big impact on natural resources, as we'll discuss later, on manufacturing in general. And we have markets right now where the difference between the expensive things and the inexpensive things is the highest it has ever been. It is not normal to be able to buy a company like, I don't know, Daimler, which almost prototypically has the best, one of the best brands in the world. I mean, people talk about the Mercedes of whatever as to say the best thing in that field. Well, that company has been trading for a number of years at P's of 5 and 6. At the same time, many companies were trading at P's of 30, 50. So that is not normal. And that is probably changing now. So that would be for these environmental things. I think it's a setup that should help our way of investing, in fact, because it should favor value-oriented, income-producing things. You know, the higher interest rates, the sooner you want the profits, and that is value investing at the end of the day. So I leave it to Marcos now.
Yeah. Hello. Good morning, everybody. Thanks for joining the call. I'm going to go down from our kind of macro view to the classic fund. So the headline here is the classic is back on track. So the fund recovered all the losses of last year, the mark-to-market losses, obviously, and we started very well this year. The fund is up 20%. And as always, we divide investment in two. This is something we learned from Keynes. There's two things to really take into account here. One is the capital preservation. So we don't want to lose money. This doesn't mean losing money for the fund. It means losing money for every investment we make. And if you don't lose money in any investment, then it becomes easier. So we are satisfied with what happened last year. So big crisis, and we more or less passed relatively well the crisis. And the second premise is a decent return. So capital preservation and a decent return, and the returns are converging for the fund to 8, 9, 10% per annum. So since inception, almost 20 years ago, 9%, 10 years, 7%, 5 years, 8%. So, you know, whichever the time you look at the fund, convergence is around 8, 9% per annum, which is okay and close to our target. You know, I never thought I would say this, because whenever you have a crisis, you get very nervous in this type of business. But now, you know, we are looking forward to see more recessions, because looks like we'll do good business there. The fund is well positioned. If we move to the next slide, You can see the current NAV is for 90 euros per share. It's a bit above of the target that we set in the beginning of the year, but this happens. I mean, the market, as JP Morgan said, fluctuates. We have an intrinsic value or close to 700 euros per share, which is an upside of 40%. And the return on investment now at current price is 13%. So still very attractive, but at more normal levels, not like last year. If you make a very simple calculation, 10% per annum makes the fund to double every more or less 7 years. The fund will have 21 years in 2023. So if we start with a NAV of 100 euros, we should be around 740. This is the mathematical calculation. And our intrinsic value is suggesting almost 700. So getting there. And you know, we've passed 2 big crises. So we are gaining kind of confidence on this 10% per annum performance. We move to the next slide, Alex, please. Basically, you know, I wanted to talk a little bit about positioning. 4 or 5 years ago, the fund was positioned in 4 main drivers. One is value, obviously, because it's our philosophy. The other one was oil or energy, then copper, commodities, and salmon farms. Out of these 4, in the last few years, 2 have already paid off. So we made good money in copper and salmon. But we are still waiting for the other 2 to materialize. One is value. As you know very well, value has underperformed, and the fund is fully value. We have basically 2/3 of the fund is traditional value, means good businesses at a discount, and 1/3 is quality or GARP, which means, you know, excellent businesses, excellent franchises at reasonable prices. You know, this is important. One of the big differences between SIA and the team here is that we do not, and other value managers, is that we do not buy bad businesses at any price. Really, buying bad businesses means you have a lot of negative options, and then if you have a crisis, you end up losing your money and you don't fulfill the first premise. Please, Alex, move to the next slide. Here, you know, I'm going to go through the 2 of the drivers that are left that, you know, we are positive on, and it's very related with what Carlos was saying. Value has underperformed for the last 5 years massively, as you can see in the chart. I mean, it's really off the charts here. And there's a couple of things to say here. Value is extremely correlated with the economic cycle. So normally when the cycle accelerates, value performs well. And in the past few years, the cycle has been always under threat. It looks like we will have 2 or 3 or 4 good years ahead of us. And second, there's a huge valuation gap also, as Carlos was saying, between value and growth. I mean, if you start by tech is valued at very high levels, and some of the value names are really very, very low in terms of valuation. Just note that value and growth do converge, so we expect some mean reversion. And the second, one of the other drivers that we are waiting for materializing is commodities. We have 15% of the fund in energy, in oil, basically. Copper has paid us very, very well last year. We have some stocks that have multiplied by several times from the minimums, from the lows. And we're waiting for oil that we will enter later on. But if you look at the chart, you can see the S&P 500 versus the commodity index. I mean, it's really, really all-time high. And this will also mean revert. We will enter in more details later on. By the way, we have rebuilt, or we are rebuilding our position in salmon. In the next slide, I wanted to, you know, explain a little bit what we did last year very fast. So last year we were really rushing to buy things. Sometimes because the NAV of the classic was 250, everything was extremely cheap. We didn't really know that the recovery would be so fast. What we knew is that we were in the bottom in the second quarter of last year, and we bought oil, we bought aerospace, we bought salmon, and we bought basically catering, cleaning services, which is support services. So these 3 sectors, aerospace with MTU, Raytheon, Thales, Sodexo in catering, Compass Group in catering, ISS that we had already, but we invested more. And then in salmon are the ideas we have brought to the party in the lows of last year. We wanted to buy airlines, but you know, the market was so fast recovering that we didn't have time to do the due diligence. So this explains more or less half of the classic, you know, between these 4 sectors, It's half of the classic. And then we have 5 big stock, big weightings that explain another 25%. Grifols, which is a plasma protein company. I'm going to enter in detail here. Henkel, you know very well, it's laundry, it's adhesives, and it's personal care. Devro is the sausage casing. Heidelberg is a worldwide leader in cement, and ING, the bank. So, you know, this is 25% of the bank. All of the classic, all of them are excellent or good businesses and traded at very low multiples. I mean, ING as an example, it's trading at 0.75 times book value with returns already at double digits. So really good money to be made here. If we move to the next slide, this is the view from the top of the fund. You know that we split the fund in 4 categories of risk. More or less, we have 55% of the fund now in 1 and 2, and this is moving up because the market is becoming a bit pricey, and we have 43% in category 3. In terms of sectors, we already commented basically everything, and in terms of geographies, 73% is Europe. Why? Because it is cheaper, and second, because we sold some of the copper assets, which were basically North American companies. But bear in mind that a lot of companies we own in the classic are global, are truly global. So really this breakdown is not really representative. And yeah, this slide just shows up something very interesting. So it's the same, the categories, but it shows the 10 biggest position of the classic right now. And it's really amazing. I don't control the 10 positions every day, but look at this. Cement company, 7%, a bank, 7%, salmon, 6%, cleaning, catering, 5%, Grifols, plasma, 5%, cleaning, 5% ISS, defense, Thales, 5%, Devro, sausages, 5%. You know, we want to be diversified and concentrated in the same moment, and this is the kind of the explanation. I mean, we have half of the book here in 10 names, and all of them are very diversified with a heavily concentrated fund, which is the way to try to beat the market. Okay, moving to the next part of the presentation, I'm going to go fast to one of our main positions. It's important that maybe you understand how we analyze things. I think we go really pretty in detail. So I'm going to present Grifols, which is a kind of different value name. It's not a pure value, it's a quality name, and it's what we call GARP. So excellent franchise at a discount. This company is a worldwide leader in plasma proteins, more than 20,000 employees, 5 production sites, 300 collection centers, 5 billion sales or more, EBITDA margins close to 30%. It is vertically integrated, means they collect the blood because plasma has to be taken from the human blood. So you need to take blood from people, and you need collection centers. And the main 4 proteins that you can see in the next slide are immunoglobulin, albumin, alpha-1, and factor VIII. I'm going to go very fast here, although it's relatively easy to understand. Alex, if you move to the next slide. In terms of immunoglobulin, it's basically a protein that acts as an antibody, and it's a part of the immune system. Albumin is a major blood protein. Main function is blood pressure, maintaining the blood pressure, and also transport. It's very used in the operations in the hospitals. Alpha-1 is a protein that is used to, to combat a disease in the lungs, which is if you don't have this protein, you have this lung disease, so you need some protein to help you in the disease. Factor VIII is very, common. It's hemophilia. And then they have some diagnosis assets, which are related to the blood collection. So these are the main proteins. Why we really like this sector? I mean, it has huge entry barriers. I'm going to go through the main entry barriers here. Oligopolistic. 3 leading companies, including Grifols, have more than 2/3 of the market. I think it's 70%. For the whole process, you need permissions from the FDA, from the European Medical Center. You need, for every country, the approval, not only for the product, but for the blood collection and from the industrial process. Then so another entry barrier, it's intensive in research and development, so intellectual property. So you need to have a huge know-how in terms of the proteins themselves and the production. And then it's a long-term investment cycle, because whenever you decide to increase capacity, it takes like 7 years. Finally, you have some switching costs, because once a doctor and a patient use the product, it's very difficult to change. So, you know, huge entry barriers for the sector. We like this sector. In the next slide, we present why we like Grifols. Grifols, it's an excellent management. You know very well that we really bet on good management. For us, it's a sine qua non. It's growing. I mean, it's almost high single-digit growth. For the last 5 years, it has been growing 7% organic, and it is sustainable in our view. Margins are improving because they are doing an effort in order to be more efficient and to increase capacity with better margins. So probably they will beat the EBITDA margins in the future higher than 30%. Vertically integrated, as we said, strong focus R&D, industrial processes, and good returns. So really, this company is a high-quality company. In the next slide, I wanted to talk about opportunities and threats. I'm not going to enter in detail here because I don't want to kill anybody here, but in terms of opportunities, the main opportunity would be the acquisition of the Chinese leader. They bought 26% of Shanghai RAAS in China. So you can imagine the market that is being opened there. And in terms of threats, is the usual threats is the products that other companies are developing to compete with them. We don't see any product really being very, very relevant in the next 5 to 10 years. So the opportunity looks good. Finally, on valuation in the next slide, I mean, this is really crazy. It's a gift. And we have bought 5% of the portfolio. Price earnings, 13 times for the share we have, which is the preferred. This share has been trading on an average of 20 times, so nothing to say. One of the competitors trades at 40 times. And whatever, our intrinsic value for the name is 24 euros. It's trading at 15, IRR 14%. Why it is cheap? It is cheap because last year was a bad year. COVID-19 prevented the blood collection system to work efficiently. And these guys have been investing a lot, including acquisitions, in order to take the company to the tier 1 level, to these 3 oligopolistic structures. So the debt is a bit high. We would like to see the debt lower, but we think that the business model really withstands this debt level. So, you know, this is a kind of brief description of one of the holdings where we have a 5%. I'm going to move to just one more slide for me and then pass it on Carlos again. So I'm going to go through the natural resources just as an introduction. The natural resources has also recovered the losses of last year. It's now trading at 110 euros per share. Intrinsic value 150 per share, so it's a good 40-50% upside. Current prices, the IRR is 14%. So it's important to note here that this sector is super cyclical and the valuations move up and down massively. The beta is super high, and our DCFs and our intrinsic value are calculated on convergence. This means on mid-cycle estimate. So we never use copper at 4.5 as it is now to do the numbers. We use copper at 3.5, which means that, you know, the midpoint of the intrinsic value is just in the middle. And as we saw last year, it moves a lot. The fund last year in the low, it touched 50 euros per share, so 1/3 of the intrinsic. If I go to the other side of the equation, I mean, if I apply the same variance and the cycle, you know, goes well, we should see 250 or 300 euros per share because this sector moves that way. And I think Carlos will try to explain a bit more why the sector is so cyclical. Just 1 second more. Tactically, we reduce the weight of copper a little bit, just tactically. We are very, very bullish on the sector. It's still 20% of the fund. And a quick view of the fund, 40% of the fund is now in oil. Why? Because we think it's going to follow the copper way, but with a couple of years of delay. So we are very bullish oil, and the shares are super cheap. We have 20% in copper and 20% in mining, excluding copper, mainly nickel and uranium, where we see that there's a scarcity of supply. Finally, we have a 10% in infrastructure, and it's a sector increasingly interesting. So we'll probably increase the weighting in the next few years, and another 10% in agri-food, which is now basically salmon. So I hand over the presentation to Carlos. Thanks.
Thank you, Marcos. Well, this is a slide I think we've shown in the past. This is the index of natural resource prices divided by the Standard & Poor's 500. So this is the excess or deficit price of this sector over the other. Now, as you can see, it is extremely volatile. Extremely means, you know, things multiply by 8. So two things just from a graphic point of view stand out. One is those huge peaks and valleys, of course, and then how prolonged these cycles are. We have 15 years between peaks. So this is not your typical, you know, ups and downs of the market. You see those up and downs in between, obviously. These are huge ups and downs that last for years and go very high and very low. Now, why is that? We can see in the next slide, we differentiate two types of commodities. You have soft commodities and hard commodities, to simplify. Soft commodities, which are basically agricultural, their prices are fairly random and chaotic because they really depend on weather, which we do not know how to forecast a year or 2 years ahead of time. So if you have a drought, if you have a flood, if you have a bug that eats the plants, whatever, then you have a very bad year, or the opposite, a very good year. And the prices obviously immediately reflect that. But those prices are first unpredictable, and because they depend on things which we cannot predict. And second, they're short-lived because normally in a year's time, the new crop fixes things. Either it is better or worse than before. If there is too much of something and the price crashes, farmers plant less of that. And then for the following year, there is less of that. So although there are cycles, of course, they're much short-lived and fairly unpredictable. So it is not easy for a long-term investor like us to make money there. You can make money, maybe if you're a trader who knows exactly what's happening right now everywhere in the world and playing those short-term variations, but not for a long-term investor. Hard commodities, which basically means minerals and oil, on the other hand, are very different. Their demand is fairly constant, contrary to what many people believe. So the price of copper doesn't depend on China accelerating or not. Whatever the Chinese do, the demand for copper is pretty much the same every year. I mean, it goes up with GDP, and the same thing for almost everything else. And what is very cyclical is the supply. Why? Because if there is excess supply, prices crash, and if there is not enough supply, prices go through the roof. Why? Because nobody buys an industrial commodity for pleasure. You know, we buy coffee because we like coffee. Nobody buys copper because they like copper. You buy copper because you are making an electrical engine, and without it, you cannot make the engine, period. Which means there is much more price rigidity because there is no substitution. If coffee prices go through the roof, which is what is happening right now, because there is a big drought in Brazil, well, people who are more price sensitive just drink tea, you know, end of the problem. So much less demand for coffee. There's less supply for coffee, well, less demand for coffee, and the price does not explode. But if copper goes up, you cannot just buy tin and put it in your electric car. You have to keep buying copper. There is no option. In the short term, there is basically no option for anything in industrial materials. So people keep demanding the same amount. And if there is not enough, it cannot be produced. Farmers can plant more soya, and in 6 months' time, you have more soya. You cannot open a mine in 6 months' time, or in 1 year, or in 6 years, or in many cases in 10 years' time. So when there is scarcity, it lasts for a long time. When there's excess supply, it lasts for a long time. It is symmetric. If coffee becomes cheap, some more people may drink coffee, but if copper becomes cheap, nobody's going to buy more copper, obviously. Well, very marginally. So if you see in the next slide, this applies clearly. We can take a look at now two commodities, copper and oil, and see how it is playing right now. You go to the next slide. This is the copper price for the last 40 years, 45 years. This is a logarithmic slide because it goes up and down so much that it is very hard to make sense of it. And then you see the 3 cycles. First, we have a very long down cycle. It lasted more than this because, in fact, it starts earlier than the chart. And the prices went down during these years by 3 times. Now, why was that? Because there was excess capacity for a number of technological reasons. We'll not get into it because it's kind of boring. But in the early 80s, the world found itself with excess capacity to produce copper. And then, like always when that happens, the copper price went down. And it kept going down because there was excess capacity. It was continued situation. Now, eventually mines deplete. So you cannot take copper out of a mine forever. Eventually the mine is empty. And demand keeps going up. As we said before, demand goes up every year. So even if there's excess capacity after a number of years, on the one hand, you have less capacity because there is some mines that come to the end of their life, and demand keeps going up. So eventually, demand catches up with supply. And that happened here in this chart. You can see it in the early 2000s. And then there is not enough copper. And since nobody has been investing for 20 years because this was a horrible business, well, there's not enough copper and there's not enough copper. Now, people start building mines, but that takes a very long time. What we see is 10 years of extremely high prices. Prices multiplied by 7 in this last cycle. And during those years, the companies made a lot of money. Obviously, companies which had not gone bankrupt selling copper at 0.6, you can imagine how much money they were making selling copper at 3. And all that money that they made, they invested in new copper mines, which took some time to start production, but eventually they did. And they overwhelmed supply. This is the essence of the cyclicality of the sector. In January 2011, copper reached $4.62 per pound, and lots of mines came into production, and the price started going down. In this new cycle, the price has gone down 2.3 times, okay, which is even more than in the past because we've had less inflation. So it's a big drop. Starting in 2011, 2012, everybody stopped investing in copper, in new copper mines, as you would expect, because they started losing money. And now we are in the situation where there are no new copper mines. As you can see in the next slide, we have not invested in copper. This is just a very simplistic, a very simple show of copper capital expenditures. They've dropped. Nobody has been building new mines, which you can see in the next slide makes things even worse because copper grades are going down. The good mines are finished. It's now more and more marginal mines because the good ones, obviously, we start using the good ones, not the bad ones. So this is getting worse and worse. And to this, you can see in the next slide, I said before that demand for these things is very stable, but this is a counterexample. Demand for copper is accelerating because of the energy transition. We read every day in the newspapers how, oil companies have to produce less oil, how electric vehicles have to, take over, renewables, everything, which is good. I mean, fine, true. But an electric car requires 80 kilos of copper. If you want to make a million electric cars, well, you need then, 80 million kilos of copper. If you want, and they need chargers, and they need the network. If we, I don't know, I live in Geneva. If in Geneva, 10, 15% of the people connected an electric car tonight to charge it, the whole thing would blow up. The electrical network is not built for that. It will be, but it is not. And that means copper. Electrical networks are made of copper. So total demand of this, taking very conservative penetration by electric vehicles, would be 2.6 million in 2030. But if you go to solar panels, they require an enormous amount of copper. The back is copper, all the cables are copper, etc., etc. And you have to link them, of course, to the network, and that is copper. Here is a missing word. An electrical turbine, you know, those things huge, windmills that we see, take 4.7 tons of copper. I mean, between the turbine, the transformer, and then the connections again. So when you put all that together, what you realize is that we need, in 10 years' time, and these are conservative estimates, we don't believe we'll get to net zero, among other things, because we cannot do it because there is not enough copper. I mean, as simple as that. But all this is an increase in demand per year of about 1.5%, 2%, when the normal growth is 2%. So this is doubling the rate of growth. And as you can see in the next slide, there are simply no mines for that. Copper mines must be started 10 years before the demand, because that's the time it takes to build mines. And there on the left, you see on the dark blue, it is the amount of production that we can expect out of the mines that we have. Goes down because mines get empty. And then the blue line is what demand would be if we do all these things that we say we're going to do. Now, one thing we can be sure of, demand is not going to be higher than supply. We cannot use the copper that we do not have. I mean, it is as simple as that. Which means, as you can see on the right-hand side, that the price is going to have to go up. It's going to go up to cool demand and tell people maybe don't buy this, wait a little bit. And also to incentivize supply, to convince people to really do as much as possible with the current mines, start building new mines, accelerate projects, etc., etc., etc. So we're going to see many years. I was going to say 10, I don't know how many, it could be 5, 10, well, not 5, 10, 15 years of very high copper prices, and driven by scarcity and demand, and we hope we can profit from those. As you see, you look at the next slide, we truly believe that we are where we were in 2003. So some people, since copper companies have gone up quite a bit, the shares in the last few months, some people are telling us, are we late to this party? Well, as we showed you before, cycles in this business last 15 years. So you are not late to this party. If we are where we were in 2003, well, you can expect the copper price to multiply by 3 from where we are, or 4, which company shares, the shares multiplied by 20 in the last cycle. So we believe this, I mean, this is a fact. This is not a prediction we're making. Share prices did multiply by 20 in the last cycle. And although they've gone up in the last few months, they were just basically recovering the crash from last year. So they are not expensive by any means. And we believe this is a very, very good opportunity. It's not a once in a lifetime opportunity. If you are patient, you'll have this opportunity every 15 years. But this is one of those years. Okay. And now I pass it to oil, to Urs, I think.
Thanks, Carlos. So maybe I will have a few words on oil. To begin with, you see the oil demand historically here. It's quite sticky due to the same reasons Carlos explained about other things. So simplified, oil is just global GDP. Half of the consumption is providing the world transport, and the other half is providing all the goods we consume, which are not made of metal or have grown organically. So every toothbrush, every windmill, every tire, every laptop at the end is made of oil. And historically, the consumption has been pretty stable. You see on the left-hand side, going back quite a long time, you have little blips, which have been created by central banks mainly as they hiked interest rates and created a recession. And you see one big decline in oil consumption. That was the 70s. And that was more a supply-driven issue, mostly politically probably, but this has led to a decline in oil consumption. By the way, in 1980, the bellwether stock to own was Schlumberger, which is comparable to today's Amazon. And we probably would not even oppose the opinion of some pundits and analysts, which project that we have had a peak in oil consumption, let's say last or the year before, but probably due to different reasons than people might expect, maybe more the supply side than the demand side. And to the next slide, probably Alex. This is what Carlos and Marcos mentioned, you know, what happens in a region post-COVID when it's normalizing. You see Chinese oil imports already did hit new highs. And now this summer, when the world is going back to normal mobility and the driving season starts, we could see something similar, and there's no reason to believe that it's going to be different in other regions. And given all these economic stimuli we have from central banks and fiscal-wise, it's difficult to see that the world economy is not doing the same as it did in China. Particularly at the moment, we can get oil companies below EV/EBITDAs of 3 times. It's the most hated sector. And as Marcus said, the charts looks quite similar like mining did last year in the summer. And therefore, we are quite optimistic on this sector. This is an interesting chart Alex found. You see the different per capita oil consumptions, the same as everything in commodities and other things. You know that the emerging markets have a much lower consumption per capita. China is around 1/3 of energy consumption of the West or of the US. India is probably 1/10 or even less. You see some outliers here are mostly countries with a small population and a very big area like Australia, Russia, Canada, which has a lot of transport intensity in the economy in relation to the population. And maybe a nice outlier is Saudi Arabia, which consumes a lot of their oil themselves. That's obviously, if you build ski halls in the desert, you need a lot of energy. And therefore is also a reason why Saudi Arabia plans to build a nuclear power plant to replace this internal oil consumption and spare it for exports. Maybe to the next slide, Alex. That's maybe a word on this EV discussion. If you take the oil demand, around 6% globally is aviation. It's higher in OECD, and not all of the aviation is leisure mobility. So there's also transport, cargo, and so on. And only 20% of the oil consumption is cars. So if you would expect the projections that we have in 2030, at 10% of the cars being EVs, so it would make up for 2% of global oil consumption. That's around half of the annual depletion we have in the market. And by the way, buying an EV doesn't mean that you have an impact on oil consumption, because if you have it as a secondary car, it doesn't mean it uses up the oil consumption all the time. Maybe to the next slide, Alex. Maybe that's an interesting, and I will have to spend some words on that. It's about abundance. So I suggest people start up looking a bit on the periodic table of chemical elements. And I would have a different opinion, as Carlos said, that you can't replace copper. Copper can be replaced. It's only the second best electric conductor on the world, because the best one is silver. It's 5% more efficient than copper. So hypothetically, you can replace copper with silver. It would make the cable 5% lighter, 5% thinner. The problem is that silver is 1,000 times less abundant in the Earth's crust. So silver is being used as an electric conductor in the high-tech industry, but it's not available in size. And this is an interesting chart from an organization. I sometimes have a bit doubt about them, but obviously they show here the coal revenues worldwide in relation to metals or other things. You see it's mostly copper, but the coal price per ton is around 100 times lower than copper. So it shows you a bit the size of the market in tonnage, let's say carbon coal in comparison to copper or other minerals. Now this slide is a bit strange, because if you say that you will replace some part of the transportation with electric vehicles, obviously copper is not producing energy. So you could say you can replace oil, but obviously not coal, because coal is the highest electricity provider in the world. So it will really not obviously use more electricity, but coal is taking oil. Oil is not a chemical element. Oil mainly consists of carbon, of hydrogen, nitrogen, sulfur, and oxygen. And carbon is the number 16 most abundant, 17 most abundant in the chemical periodic system, hydrogen number 10, and copper is 25. Copper, for example, is 5 times or 4 times less abundant than carbon. And the other problem is the genesis of metals. So carbon, so occurrence in the Earth's crust is very concentrated and very clean, so it's relatively easy to produce, whereas minerals are very scattered, and it's a very rare occurrence in concentration. So most of the copper in the Earth's crust is not recoverable. So what I want to show a bit here, I could have named the slide, everybody can get drunk on Chateau Petrus, but the problem is there's only 30,000 bottles a year, so 100 people can drink a bottle of Chateau Petrus per day. So you can replace part of the global transportation with things which are much scarcer, but you cannot do it in the size people are talking about. Maybe to the next slide, Alex. So that's the problem. We have. Same problem as everywhere. We have around 3% depletion. On the right-hand side, you see what happens with oil supply without investments. And this is to show a bit the size. It's so it's 3% depletion, means a new Saudi Arabia every 3rd year, or the biggest oil field like Gawar, which produces 3.8 million barrels every year. And of course, this is problematic. You need investments. And we have, for example, the future of conventional oil is pre-salt in Brazil, which is below 2,000 meters of salt crust, and it goes down as 7,000 meters offshore, or the Arctic, and so on. That's the same reason Carlos explained. We have more and more costs, and it gets more and more difficult to replace these investments. Maybe on the next slide, Alex. This is some words about shale. Marcos has explained that in our conference calls in details many times. So shale was able to provide the oil production of a size of Saudi Arabia in the last 10 years, but this bubble is broken. It's always the same. If you have a growth story, nobody cares about economics, and everybody's happy about production growth. And this is now over. This market can be compared to the oil sand boom 15 years ago. It's, by the way, a similar mining process in situ, and you have very different economics. It's a short cycle. You can bring up production quickly, but it fades quickly. Now this market is now getting consolidated. It's the major companies which are producing it, and there's a lot of debt which is unservable. And this boom will not come back to the degree it has been, because the big companies are now cautious on the investments and so on. So this is the same chart in oil as Carlos showed in mining. You see the capex collapse. You see this on the lower end chart in Canada. Maybe the lower end chart is the capex in Canada. It's an interesting region because it provides around, 4% of the global oil market. And it's a region where you could grow production in the oil sands. The problem is, if you don't want to build a Keystone pipeline, nobody will invest in oil production because you don't have transport and you don't have an end market. The whole discussions we have about ESG and all this stuff, nobody wants to invest. For example, shale oil, it would exist in other places on the planet, let's say in Argentina, Vacas Muerte, but who is going to invest in shale oil in Argentina at the moment? So we see the same problems as we have seen in mining, massive underspending, and we will have a world which is facing tight supply for the next decade to come. And here is maybe a nice chart what would be needed in terms of capex to fulfill these requirements. And maybe just to have some figures to what this means is that the biggest oil project at the moment is Vostok Oil from Rosneft in Chukotka. That's the most northern eastern region of Russia, the least dense populated area in Russia. And this should reach production peak in 2035 with 2 million barrels, half of today's Gawar. We would need every year two such projects to cover the depletion, and the numbers are, it's around $150 billion. That's double the market cap of Rosneft. That's India is part of the joint venture now, and Trafigura. It will need 450,000 people to build it. It will need 150,000 to run it, and 15 industrial towns need to be created, like Norilsk, because it's like in the war. If you have one working there, you need to have 10 people on the back, because if you have people there, they need schools, they have kids, they need hospitals, etc. So this shows a bit the scale and the size of investments which would have been needed the last 10 years to keep up production stable. And just a quick summary on what that means. So we see demand obviously coming back, and it's already happening, and it already happened in regions like China. So we can expect 103 million barrels next year. And with all this huge stimulus, which is unprecedented, it's difficult to see that differently. And on the supply side, nobody knows exactly, but I have we can take shale. So it's already happening or not happening that oil prices are above $60 per barrel, but it's not happening what people expected, that we have a huge rush to investments because it's gone. No, the bubble is broken, and the big companies are now conservative and do proper calculations. Then we have spare capacity in OPEC, Russia, that will come back to some degree, but it's questionable how much the spare capacity really is. Part of it is maintenance, and you can also look at the capex of Aramco. It's collapsed similarly than other companies, so it's not different that Saudi Arabia lives on another planet. They would need investments, etc., and they have the same structural capex decline and collapse everybody else had. And maybe Iran is a word. Interesting, just the West thinks because Iran is under sanctions, they don't export oil. Obviously, it's quite known, and everybody says it. Iran exports still oil just to China and India. The problem there is more that they would need investments and spare parts and these kind of things. But I think it's the risks regarding oil demand supply in the next year is probably rather on the negative side in terms of supply than on the other side. Alex?
Thanks a lot, Thomas. I would like to sum up basically to go back for a minute to the classic fund. Here you see actually the see-through profitability of the classic fund updated as of end of April. You see that the fund is on a 22 earnings trading on the 14.9 times, substantially cheaper, less expensive than the MSCI World, with a 2.8 dividend yield and 1.7 times price to book. If you look at the performance, as Marcus indicated at the beginning, we are close to the 10% here since 2011. But of course, value was underperforming growth quite substantially. We have actually received an interesting request from a pension fund advisor from the US that actually wanted to have our classic fund just a carve out of our European portfolio, here measured against the Eurostoxx 600. And what you here see, it's quite interesting to me. It's basically, we were able to outperform nicely the Eurostoxx 600 up to a magnitude of 160%. But of course, the biggest deviation in the market were really in the US, where you had technology really going through the roof in evaluation terms. And that's why we were actually able to beat the markets in Europe, because this time, a bit different to 2000, the big outliers are really focusing in the US market. And now going to the see-through profitability of the Natural Resources Fund, also updated as of end of April. You basically see it's trading at 11 times earnings 2022, 3% dividend yield, and the price to book of 1.2. And what's maybe interesting to mention here, on the 22 or 23 basis, these are all on estimates that actually analysts expect lower commodity prices, which is obviously not true if you have listened to us now. So we believe the true PE multiple of next year is probably going to be 20 or 30% even lower than we indicated here. Now, we believe it's important to know what you have in your portfolio. And here we compare from the last upcycle from 2002 until 2007, we compare Royal Dutch with C&Q, and you basically see that a Royal Dutch total return-wise was yielding 34%, whereas C&Q was actually multiplying by 5. As Marcos indicated well as well, was that we have a higher beta, meaning in positive markets we are outperforming here the natural resources index from S&P, but of course in negative markets, as we have seen last year, we underperform. And the last slide from my side is this one. Basically, you see in the last upcycle now since March 23rd last year, we outperformed extremely basically the S&P natural resources index. At this point in time, we basically would ask the audience to raise your hands, and maybe with this little last picture that we show here, is it the new hybrid solution that's actually a Tesla car parked at the sideway and actually with a diesel generator tries to load some electricity. Now, as indicated, if you would like to ask now questions, you can actually now raise your hand, and then if I see it, I can unmute you, and then you could actually ask the first question. Who would like, I see here somebody has raised the hand.
Yeah, hello, good morning or good day, and many thanks firsthand for your good presentation. It was a good insight. And Alex, you just showed the steep drop. Yeah, it was caused due to Corona in March last year. But what were the contributors for the recovery of the performance? Which were the the performance attributions to the fund?
Maybe Marcos?
Yes, yeah, I have here some performance attribution numbers that we were preparing for the call. And basically, if you look at the names that last year, from the trough last year to now, have done better, the number one would be First Quantum. This is a copper company. The number two would be a surprising name for all of us and you guys, probably, is Pandora. The jewelry company, you remember that they had a very, very tough period, but now they have recovered very well and is the second contributor. The third one would be another copper company, Hudbay Minerals. The fourth would be an oil company, Cenobus. The fifth would be a salmon company, Leroy, because we put, it did really bad last year and we put a lot of money, so the weight was very heavy there. Then very fast, ING, Devro, Cas Minerals, EOG, Antofagasta, Apple, Heidelberg, Hess. So, you know, again, it is true that the sector that has performed the best has been copper. I mean, to give you an idea, First Quantum was at some moment traded at 5. It is now trading at 28 Canadian dollars. So it's a 5-bagger in 1 month. So probably, you know, the copper sector has been the stellar, but it's quite diversified. The contribution of the best performers is quite spread.
Thanks a lot, Marcos. Is there any other questions that you would like to ask? Otherwise, if I'm looking at the watch, we actually already passed the hour.
The chat, Alex, the chat, I think there's been a question in the chat.
Okay, sorry. Marcos, do you see the chat on Grifols? How do you account for A and B shares? The goodwill is quite massive in the last years for latest purchases. How do you check that they will be able to create value with this?
Yeah, there's two questions on Grifols. One is on the A and B shares, then the goodwill, and then the debt. So there's 3 questions here. So one of the reasons why Grifols is cheap is the debt. They have, I think, 6 billion net debt. The EBITDA is probably 1.5 billion. So it's kind of 4 times net debt EBITDA. We believe that the process of taking the company from being a tier 2 to being a tier 1 company has lasted 10 years. And this is the reason why the debt is so high, because they've been buying collection centers, they've been buying also some product companies in order to complement their products, and they've been also opening facilities. So really the work has been very good, in my opinion. I was a little bit disappointed because this level of acquisitions has prevented the name to do better. But after talking to them many, many times, you know, what they say is that they couldn't really stay in the tier 2 world. I mean, this business will go to only to 3 guys, and they wanted to be there, and they are there. And now the entry barriers are massive, so we will not see a number 4 in the sector. So from that aspect, now the company will generate very good cash flow and reduce the net debt. So I'm not really worried about the balance sheet. On the preferred shares are cheaper, a little bit cheaper. And as a value investor, we prefer to buy the cheaper stuff. In contrary, you don't vote for the you don't have the voting right. But as this is in the hands of a family, voting is not that relevant for us. So we prefer to have a higher dividend yield and not to vote. Anyway, if there is a takeover on Grifols, we would be invited to participate in even if you are in the B share, in the preferred share, you are invited to the takeover. So on that front, we are fine. And finally, I think these are the three things. Debt, acquisitions, and shares. So we are very convinced that this thing will give us a 40-50% in the next 2-3 years. Not next year, but you know, they are very well set for the next 2, 3, 4 years.
Thanks a lot, Marcos. There is also a question on Antofagasta and our favorite copper stocks. Who wants to answer that question? Carlos?
Well, yeah, okay.
Carlos, please go.
What is the question, sorry?
The question is, which are our preferred copper stocks and the Chilean country risk for Antofagasta?
Okay, Antofagasta is a company that within the space has typically traded at a premium because it was perceived as having very low country risk, particularly when you realize that the other copper places are Indonesia, Congo, Zambia, Peru. Well, of course, there is some in the US too and other places, but anyway, and Antofagasta is a family-owned company which has always been fairly conservative. They have not destroyed too much value in the good years, etc., etc. Now, none of that has changed, but as you probably are aware, there is a new law in Chile which has been introduced by the Congress to sharply increase royalties on copper companies. Then there has been, they have voted for a new constitutional assembly. They have to come up with a constitution and a Senate. So I think it's going to take some time. Having said all this, taxes for all mining companies will go up everywhere. That is a fact of life. The same way I told you that the share prices will multiply, well, they did multiply by 20 last time, and we're in a similar situation. Even surer than that is that taxes will go up. All governments need money, and when they see these companies making much more money than in the past, they believe, and perhaps rightly so, that at least some of that money belongs to the country where the mineral is. Now, a mining company, unlike a tech company, cannot flee. I mean, the people can, but not the mine. So you cannot go away with your mine. So if the government decides that you're going to pay more, well, you are going to pay more. And that's the way it is. Now, it's not the time to get into a very detailed microeconomic discussion of why that has no impact on long-term profits for the companies. That has an impact for the users, not for the producers, but that's a different issue. In any case, we do not think that Chile's country risk is higher than in the past, because now Peru is going to do the same, and all the other countries will do the same. So all this will do is simply increase the copper price, marginally reduce copper investment, which means even higher copper prices. So it's a fact of life. I mean, I like to remind people that the first thing that the Cameron government did in the UK when they finally beat the Labour Party, and then the Conservatives came to power after 10 years, the very first decision the following day was to increase taxes on North oil companies. So this is not a third world country, this is not a Marxist government, but this is the first thing they did. So yeah, we don't see any special country risk. We do see higher taxes all across the board, also in oil companies, by the way, as oil starts going up. That's how it works.
Thanks a lot, Carlos. Maybe our favorite copper companies, Marcos?
Yeah, our favorite, I will say 3 names, which are the ones we have in the classic, because in the natural resources we have like 10 or 12. But the classic are more kind of selective in terms of quality. We have Antofagasta, we have First Quantum, and we have Hard Bay Minerals. I think these 3 are high quality, good management, good companies. We have others that are good, like Atalaya Mining, a small Spanish company that is very good, or even Ivanhoe in Congo, which reserves are fantastic. But these 3, I would highlight them.
Thanks a lot, Marcos.
Maybe to say something that sometimes it's not possible to just buy pure copper companies, because copper is often always a byproduct from gold, but many minerals occur together. Antamina is the biggest zinc mine, it's the 8th biggest copper mine. Many companies like Glencore, they produce a lot of minerals, and virtually most companies. So sometimes it's it's not possible to pick pure copper companies.
Urs, there was another question on uranium. What is your view on uranium?
Yeah,
maybe a short answer, because we have 3 other questions in the chat.
Yeah, we're holding a big position in the oligopoly, and the short answer is we are very bullish. It's one of the one of the commodities with the biggest supply issues in the coming decade.
Marcos, thanks a lot, Urs. Marcos, there's a question on the CO2 and the oil companies, how they're going to handle that. And the question is also on the major, but we are actually not really focusing on the major.
Yeah, maybe 2 fast responses there. On the majors, we don't invest in them because they need to replace the reserves. So we are more inclined to invest in companies that have already the reserves, like the Canadian oil sands. And when they reinvest in new barrels, the returns are lower, right? Because you need to, they have depletion, they need to replace. And the majors then, moving to the ESG world, which is related to the other question, that question is key. So who on the hell is going to invest in oil now? I mean, most in our meetings, our investors are saying that oil is a sector that should be avoided. And this is told to the companies. I mean, all the majors, but also in the independents, everybody is getting the message that stop investing and just buy renewables and try to reduce your carbon footprint. Okay, yeah, I mean, this is happening, it's happening. And this is creating even a bubble in the solar and in the wind farms. I mean, the prices are getting crazy there. The problem is, as Urs was mentioning, is that the demand is very sticky. Demand by the end of next year is back to pre-COVID, and we have been non-investing for a decade. And now the pressure is tremendous in stopping investments, which means that basically the price will be the factor of adjustment. Price will move very high in order to incentivize new oil fields and to incentivize also investments in green energy. That said, I mean, we agree with the energy transition and we want to bring our little impact in the CO2 reduction, and we're taking this very seriously. So in our selection, all our companies are very high standard in terms of reducing CO2. In our opinion, it's not a matter of not investing in oil or not investing in cement because it's another producer of CO2. The thing is, buy the good companies and push them to reduce CO2 emissions. But this is a bit different from the majors. The majors, the problem they have is they are too big. They are investing in several businesses and the shareholder pressure is massive. We try to look for more, mid-sized companies that have a clearer path to value creation.
Thanks a lot, Marcos. Carlos, there's one last question that we take which is we have seen basically in the charts from you and from Urs that this Green Deal will not really work. Do you think would at one point the politicians realize that is absolutely unrealistic?
Well, the answer is yes. It is going to show in the oil price. You know, you can say whatever you want, but people need to take a truck to bring the potatoes to the town, to the city. I mean, that is a fact. Whatever politicians say, whatever ESG activists say, you do need the oil to bring the potatoes. We have to eat every single day. Well, not really every single day, but certainly every single week. And that's, as Marcos is saying, after a decade of underinvestment created by excess supply in oil, like the previous cycles, now when the investment should accelerate, what we're seeing is enormous pressure not to invest. Now, people believe that if somehow oil companies were to disappear, our problems will disappear. Well, they would, because we would all die. It just cannot be done. Now, it is going to be done gradually, much more slowly than people believe, and at a much higher cost. Now, by itself, the cost is not so bad. I mean, mankind has to do something. GDP comes out of something. So instead of building some things, we'll build other things. But in open economies, that is done through the price mechanism. So what the market is going to tell us in a few quarters is that mankind better start building some oil fields, because we do need it. And this is what's going to happen. This is not a political decision. You can think whatever you want. You can vote. It's like, you know, in Switzerland, fortunately, we can vote the things we want to do, but we cannot vote to have sunny summers and wonderful snow conditions every winter. Well, we can vote, but it is not necessarily going to happen. Okay, so that's about it. People who are against oil companies do not realize to what extent their quality of life, their standard of life depends on cheap energy. It depends 99% on cheap energy. Without energy, we would be back to 1600 before the Industrial Revolution. The Industrial Revolution is not an industrial revolution. It is an energy revolution. When people learn to use coal to make machines, to do things with them, that is the Industrial Revolution. It's the coal revolution. We can go back to that, but I don't think any voter in the world is going to accept it.
Hey, thanks a lot. Thanks a lot to all of you. If you have further questions, please do not hesitate to call us or send us an email. And we would really like to see you pretty soon physically for an update meeting. Thanks a lot and take care from Switzerland.
Bye, everybody.
Bye. Bye-bye.